Hello, everyone, and welcome. Thank you for joining today. The topic of our webinar today is Hot Topics in Continuous Disclosure, what small and medium issuers need to know. My name is Maria Lobsher. I'm an accountant in the Corporate Finance branch of the OSC, and I'm the coordinator for the SME Institute this season. I'm delighted to introduce our speakers for today's session. Darren Sutherland and Yolanda Yan are both accountants. Jonathan Blackwell is a senior accountant, and Alexandra Mello is legal counsel, all in our Corporate Finance branch at the OSC. And just some housekeeping items before we begin. You can download the handouts on GoToMyWebinar. And you can also submit questions throughout the presentation using the question and chat feature, and we'll be answering them at the end of the webinar. If for any reason we cannot get to your question, we will reach out to you after the session. We'll also be sending an evaluation after the session, and we'd really appreciate your feedback. And lastly, at the end of the session, you'll be able to take a screenshot for proof of attendance for CPD requirements, so please just look out for that. Now, before we begin, I'd just like to remind participants that the views expressed in this presentation are the views of corporate finance staff and do not necessarily represent the views of the Commission. The presentation is provided for general information purposes only and does not constitute legal, accounting, or technical advice. Information has been summarized and paraphrased for presentation purposes, and the examples have been provided for illustration purposes only. Responsibility for making sufficient and appropriate disclosure and complying with applicable securities laws remains with the company. Information in this presentation reflects securities laws and other relevant standards that are in effect as of the date of the presentation. The contents of this presentation should not be modified without the express written permission of the presenters. And lastly, this document should not be distributed externally. The objective of the OSC SME Institute is to support small and medium-sized businesses in facilitating cost-effective compliance through issuer outreach and education. It is important for issuers to know securities regulatory requirements, and we are here to help them navigate regulatory waters. The idea is that if we can help issuers to better understand and comply with their disclosure requirements, they can focus their resources on building their company. Ultimately, we both have the same goal: for issuers to provide appropriate and meaningful information to investors and assist them in making informed investment decisions and to stay onside regulatory requirements. It is important to remember that at the end of the day, investor confidence in the information that companies provide is critical to the success of the company. So for today's session, our primary focus is first to educate reporting issuers and their advisors on some general disclosure principles, including timely reporting and assessing materiality. Secondly, we'll be focusing on some topical areas of financial reporting and management's discussion and analysis where we have seen deficient disclosure in the past. We'll also provide some disclosure examples to help illustrate our expectations. And lastly, we'll touch on some other regulatory disclosure areas, including non-GAAP and other financial measures, forward-looking information, and overly promotional disclosures. And with that, I'll turn it over to Alexandra to take us through general disclosure principles.
Thanks, Maria. We'll start off with our first topic covering timely reporting and materiality. As discussed in National Policy 52-201, it is fundamental for all investors in the market to have equal access to information. Disclosure achieves this by helping investors quickly learn of all material information that might reasonably affect their investment decision. However, we are concerned about selective disclosure, where a company discloses material, non-public information to only some individuals and not broadly to the investing public. This selective disclosure undermines retail investors' confidence in the marketplace as a level playing field. To ensure that everyone investing in securities has equal access to information, Canadian securities law has requirements for when and how information must be disclosed by public companies. The main types of reporting that are required under Canada's continuous disclosure regime are periodic and timely disclosure. Periodic reporting requires reporting issuers to prepare and file continuous disclosure documents, such as financial statements, management's discussion and analysis, information circulars, annual information forms, and technical reports. Timely reporting, rather, requires reporting issuers to disclose material changes as they occur. This includes certain event-based disclosure, such as completing business acquisitions or entering into material contracts. The term material change is generally defined in each jurisdiction's securities legislation and is usually based on a market impact test. Issuers should refer to their principal regulator's applicable legislation for the definition of material change, which in Ontario is set out on this slide for reference. Both securities law and stock exchange rules require timely disclosure of material information, as regulators don't want investors buying or selling a security based on outdated or inaccurate information. The main timely disclosure documents under Canadian securities law are the news release and the material change report. Part 7 of National Instrument 51-102 requires that reporting issuers immediately issue and file a news release authorized by an executive officer disclosing the nature and substance of any material change in their affairs, and to also file a material change report using Form 51-102-F3 as soon as practicable, and in any event within 10 days of the date on which the change occurs. Stock exchanges such as the Toronto Stock Exchange and the TSX Venture Exchange generally maintain their own timely disclosure policies, and it is important to note that issuers are required to comply with both securities law as well as the requirements of any exchange they are listed on. Under applicable stock exchange timely disclosure policies, a listed company may be required to disclose material information, including material facts, immediately once management becomes aware of that information. For reference, we've provided this chart setting out the timing requirements for disclosure of a material change under Canadian securities law that we just discussed. And we'll now move on to assessing materiality. There is no bright line standard or test for determining materiality, and it is a company-specific determination. It is the responsibility of each issuer to determine what information is material in the context of its own affairs. Management should ask themselves whether the inclusion, exclusion, or misstatement of certain information would be likely to influence the decision of an investor to buy, sell, or hold securities of the company. If the answer to that question is yes, then the information is most likely material and should be disclosed. If in doubt, companies are encouraged to err on the side of caution and disclose the information. This next slide sets out some examples of potentially material information as described in National Policy 51-201. Though ultimately, an issuer's management is expected to use its judgment in determining what information or development is material to their company. For example, an emerging technology company may deem the resignation of its long-standing chief technology officer to be a material change, whereas a mining company in different circumstances may not. However, in almost all circumstances, a company entering into a merger with another company would be considered material information, and the company should disclose it as such in a timely manner. National Policy 51-201 provides additional guidance for issuers on timely disclosure, materiality, and best disclosure practices. It is especially important to keep in mind these general disclosure principles when identifying the potential impacts of the current economic environment on your financial reporting and other disclosures. With that, I'll pass it over to Darren to start our discussion on financial reporting.
Thanks, Alexandra. So moving on to financial reporting and management's discussion and analysis, I'll begin with revenue recognition. As part of our continuous disclosure reviews, we've identified several areas where common deficiencies are observed with respect to the recognition, measurement, presentation, classification, and related financial statement disclosures with respect to revenue recognition. The first observation we'll discuss relates to the disaggregation of revenue recognized. An issuer is required to disaggregate revenue into categories that enable investors to understand how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. The extent to which revenue is disaggregated, however, depends on the facts and circumstances specific to the issuer's contracts with customers. Additionally, the issuer should consider how revenue is disaggregated in other communications or for the purposes of evaluating financial performance. For example, information reviewed by the chief operating decision maker in evaluating performance of segments or disclosures presented outside the financial statements in earnings releases or investor presentations. We've also seen issuers that do not disclose sufficient information to enable users to understand the performance obligations within a contract and how the transaction price is allocated to those performance obligations. To satisfy the disclosure requirements in IFRS, an issuer must disclose information that allows investors to understand when the issuer typically satisfies its performance obligations, the significant payment terms in a contract, and whether there's any component of variable consideration, the nature of the goods and services, and obligations for returns, refunds, or similar contract liabilities, as well as any warranties or related obligations. Since performance obligations may be satisfied over time or at a point in time, and therefore issuers must also disclose the aggregate amount of unsatisfied performance obligations at the end of the reporting period. For any unsatisfied portion, it's also important for an issuer to provide investors with information regarding when it expects to recognize the remaining revenue. This can be done on either a quantitative basis, using time bands that are most appropriate, or using other qualitative information specific to the contract that supports when the revenue will be recognized. And with respect to variable consideration, we've also seen common deficiencies in the assessment of whether a contract contains a variable consideration component, as well as how variable consideration is estimated. And an amount of consideration can vary for a variety of reasons. Some of examples have been provided on the slide. The variability relating to the consideration may be explicitly stated in the contract. It may be contingent on the occurrence or non-occurrence of a future event. And it could also be based on customary business practices, public corporate policies, or statements an issuer has made. So some examples of variable consideration might include a service contract that includes a service guarantee penalty to compensate customers in the event that they do not receive a minimum service standard, or an issuer that offers a volume rebate in the form of a retrospective price reduction based on a specified purchase quantity threshold. When a contract includes variable consideration, the amount of the variable consideration must then be estimated by using one of two methods, depending on which method the issuer expects will better predict the amount of consideration that will ultimately be entitled. This table lays out the two methods under IFRS 15. The expected value approach may be appropriate if an entity has a large number of contracts with similar characteristics. For example, volume rebates, where the rebate amount is based on a predefined volume metric across similar contracts. The most likely amount may be appropriate in scenarios when a contract has few possible outcomes. So for example, an entity that enters into a contract to manufacture an asset and upon completion is entitled to a performance bonus if it achieves a certain quality target. So in this case, it either achieves the bonus or it does not. Moving on from revenue recognition, we'll now go through another area where we've continued to see disclosure deficiencies, the effects of credit risk on the amount, timing, and uncertainty of future cash flows. IFRS 9 requires issuers to use an expected credit loss model, or an ECL model, to assess financial assets measured at amortized cost for impairment. The concept of ECL models is to estimate the potential loss on a financial asset, taking into account current and future conditions. ECLs should reflect an unbiased, probability-weighted amount using reasonable and supportable information available at the reporting date, while taking into consideration past events, current conditions, and forecasts of future economic conditions. In times of increased economic uncertainty, it may be challenging for companies to incorporate forward-looking information into their ECL models. However, it's not appropriate for an issuer to simply say that reasonable and supportable information is not available because it's difficult to determine. IFRS 9 does allow for the use of a simplified approach to measuring ECLs, typically through the use of a provision matrix based on historical losses. However, things like rising inflation, higher rates of defaults, and other factors leading to increased economic uncertainty could indicate that historical loss provisions may no longer be an appropriate basis for estimating future losses. Consider, for example, customers in areas that are impacted by natural disasters or experiencing other macroeconomic challenges such as supply chain issues or labor shortages. Issuers will need to ensure that their ECL models are appropriately updated to reflect any changes in credit risk when estimating their future credit losses. While IFRS 9 outlines how expected credit losses are to be measured, IFRS 7 outlines additional disclosure requirements in the financial statements. Issuers are required to provide sufficient information to enable a user to understand the nature and extent of its credit risk and how the issuer manages those risks. And this would include any changes in estimates or assumptions used in evaluating credit risk and the ECLs that have occurred during the period or are likely to occur in the future. Issuers need to use judgment to determine the specific disclosures that are both relevant to the business and necessary to meet these disclosure objectives. And just to quickly summarize, some examples of qualitative disclosures would include information about an issuer's credit risk management practices, how a company assesses whether there's been a significant increase in credit risk, and an explanation of the inputs, assumptions, and estimation techniques used in measuring their expected credit losses. IFRS 7 also sets out specific quantitative disclosure requirements to assist investors in understanding the movement in amounts arising from their expected credit losses, including a reconciliation from the opening balance to the closing balance, as well as the gross carrying amount of financial asset by credit risk rating, so that users can understand the issuer's credit risk exposure and where there are significant credit risk concentrations. The next area that we tend to see common disclosure deficiencies, which is also particularly relevant in times of economic uncertainty, relates to the impairment of non-financial assets. IAS 36 requires issuers to assess non-financial assets for indicators of impairment at each reporting period, which includes interim periods. Only if an impairment indicator exists is an issuer required to perform an impairment test, which involves estimating the recoverable amount of the non-financial asset to determine whether the carrying amount exceeds the recoverable amount. For goodwill and indefinite life intangible assets, however, an issuer is required to perform this impairment test annually, regardless of whether impairment indicators are identified. When assessing for indicators of impairment, an issuer should consider both external and internal sources of information. IAS 36 provides examples of sources of information an issuer may consider, which we've summarized here on this slide. Internal sources of impairment indicators are often easier to identify than external sources. However, particularly in times of increasing interest rates or evolving political landscapes and economic uncertainties, issuers may identify indicators of impairment more frequently or indicators that are more pervasive than they have been in the past. And it's important that issuers are providing this information to investors on a timely basis. It's also important to point out, however, that this list of examples is not exhaustive, and issuers should consider other sources of information that may suggest an indicator of impairment exists. For those issuers with investments in associates or joint ventures accounted for using the equity method, it's important to also consider the impact of possible indicators of impairment on the operations and financial conditions of their associates and joint ventures. An impairment of a net investment is recorded if there's objective evidence of an impairment as a result of one or more events that have occurred after or since initial recognition of the investment, so a loss event. And the loss event has an impact on the estimated future cash flows that can be reliably estimated. That being said, any losses expected as a result of future events, no matter how likely they may be, are not recognized. And again, this list is not exhaustive, and other information such as the external factors noted on the previous slide may also impact an associate or joint venture and indicate that an investment may be impaired. Once an issuer identifies indicators of impairment, and upon performing the impairment test, an impairment is recorded in the financial statements, the issuer also needs to ensure it's provided adequate qualitative disclosure to investors so they can understand the events and circumstances which led to the impairment, the total amount of the loss, and details regarding the individual asset or CGU to which the impairment relates. One important point to highlight, IAS 36 encourages an issuer to disclose key assumptions used when determining the recoverable amount of an asset or CGU during the period. However, paragraph 134 of IAS 36 specifically requires this disclosure when measuring the recoverable amount of goodwill or an intangible asset with an indefinite useful life, including the CGUs to which include those assets. So for assets other than goodwill or indefinite life intangibles, an issuer will need to exercise judgment in determining whether the inputs and assumptions used in its impairment assessment represent material information which should be provided to investors. IFRS requirements aside, in circumstances where there are indicators of impairment present, but no impairment is recognized in the financial statements, an issuer should consider whether discussion of the impairment indicators and factors ultimately leading to the conclusion that no impairment was recognized represents material information, which should also be provided to investors in the MD&A. And now I'll take a few minutes just to walk through an example. So this slide illustrates an example of deficient or boilerplate disclosure with respect to an impairment of non-financial assets. The issuer has disclosed that costs related to the write-down of assets during the period is mainly due to an impairment of PP&E. From this disclosure, we do not have any information regarding the events and circumstances leading to the impairment. It does not provide any details regarding the particular asset or CGU to which the impairment was recorded, and does not disclose any assumptions used in estimating the recoverable amount. This next slide illustrates enhanced disclosure that provides users with a much clearer picture. The disclosure identifies that the indicator of impairment was related to one particular operating segment with store closures and reduced operating capacity, ultimately leading to a decline in share price and a decrease in the issuer's market cap. The disclosure clarifies the impairment assessment was performed at the CGU level, being that specific operating segment, and therefore takes into consideration all non-financial assets included within that CGU. It also provides details regarding how the recoverable amount of the CGU is estimated, in this case being a discounted cash flow model, and the inputs and assumptions used in the calculation, as well as how the impairment was allocated between the assets. I won't go through this slide in detail, but just to wrap things up, this table highlights some key focus areas and examples of questions issuers may want to ask themselves when considering impairment of their non-financial assets, as well as ensuring that investors have the necessary information to understand the impact on the issuer's financial position. And with that, and that will conclude the specific financial accounting and reporting topics we wanted to cover, and now I'll turn it over to Yolanda to take us through some of the MD&A topics.
Thanks, Darren. The next item we want to address is some common areas of weakness observed in the management's discussion and analysis, or MD&A filed by issuers. MD&A should be meaningful to investors. As preparers and advisors, you can help add value to readers by ensuring that the MD&A complements the financial statements, provides balanced reporting, and is updated for new events. In addition, the MD&A should discuss material information that may not be fully reflected in the financial statements, such as contingent liability, defaults on the debt, off-balance sheet financing agreements, or other contractual obligations. So the first item in the MD&A we'd like to discuss is the discussion of operations. Often we found the discussion in relating to revenue and the costs to be boilerplate and including very little discussion of the period-to-period variance. It is important that you provide analysis of operations by discussing why revenue and costs have changed. We remind you that simply repeating variance that can be calculated from the financial statements does not help investors understand the results. In the example illustrated above, it is disclosed that the increase in revenue is mainly due to sales of product X, but it does not explain why sales of product X increased, or any changes in other product lines may have offset the sales of product X. So the disclosure above does not provide useful information to enable readers to understand the increase in revenues. The issuer should describe the key drivers of sales of product X, including customer trends, selling price, sales mix, and the introduction of any new products and service as applicable. The MD&A allows management to provide insights beyond what is contained in the financial statements. In addition to the factors described on the previous slide, issuers are required to discuss significant projects that have not yet generated significant revenue in the MD&A. We continue to see issuers that do not provide sufficient information to enable the reader to understand the project, including timing and costs associated with the project. While this issue is most often observed with early stage, development stage issuers, or those with a change in business, this requirement applies to all issuers that have significant projects that have not yet generated significant revenue. Over the past year, this has been particularly prevalent for technology-based and manufacturing issuers conducting R&D and those developing new products or technologies. Items 1.4D, 1.6A, and 1.7A3 of Form 151102F1 and Section 5.8 of 151102 prescribe disclosure for issuers that have significant projects that have not yet generated revenue. The requirements including a description of the project. This should include a discussion of both current and long-term plans. For R&D activity, the discussion should be including for each stage. Project timeline. The expected timeline of the project must be clearly disclosed, including the issuer's progress compared to the timeline and the date at which it expects to begin generating revenues. Budget. The estimated total expenditure related to the project, expenditure to date, expected timing of remaining expenditure, and how the issuer anticipates funding the remaining expenditure should also be discussed. Regulatory and licensing requirements. There should be a discussion of license and regulatory approvals the issuer must obtain. The discussion should include the anticipated timeline and expenditure associated with obtaining the license or regulatory approval, and the risk associated impact if regulatory approval and license are not obtained. Updates. The issuer must include an update on the status of the project in each MD&A, including any delays in the disclosed timeline and or anticipated cost overruns. In addition, if the issuer previously disclosed material forward-looking information, the MD&A must include a discussion of events and circumstances that occur during the period that are reasonably likely to cause actual results to differ materially from the forward-looking information and the expected differences. This disclosure are necessary to help investors further understanding an issuer's operation. In addition to the disclosure required in the discussion of operation for a project not yet generating revenue, there are additional disclosure requirements for venture issuers that have not had significant revenue in the last 2 years. This slide lists some of the costs that venture issuer must break down as required by Part 5.3 of National Instrument 151102. This including the material components of exploration or evaluation assets and expenditures, expenses, research and development costs, intangible assets from development, general and administration costs, any other material costs not referenced above. Also, if the issuer's business primarily involving mining exploration and development, this analysis must be presented on a property-by-property basis. As far as presentation goes, this information can also be disclosed in the financial statements and or the MD&A. So here is an example of deficient disclosure that does not adequately describe the project, the status of the development or expenditures. I will let everyone take a moment to read the example and know that the disclosure lacks sufficient detail and does not discuss current or future expenditures. Here is a previous example enhanced by providing entity-specific details. You will know that expenditures spent to date and expect to be spent to continue the project are discussed. In addition, this disclosure provides a detailed status of the project and discusses the progress of the project related to the big picture. Now we have discussed a few financial reporting and MD&A topics. We wanted to discuss and highlight the potential impacts of the current economic environment on financial reporting and other disclosures. Slide number 31, including some factors that are affecting current economic conditions and increasing economic uncertainty. Please note that this is not an exhaustive list. As a result, these factors may impact issuers' operating financial performance, financial position, and future perspectives. We recognize that issuers are preparing disclosure in evolving and uncertain times, resulting in increased estimation uncertainty as the assumption used to prepare the financial statements may materially change in the near term. Issuers should carefully evaluate and explaining how economic uncertainty and changes in assumptions affect their operation and the amount reported in the financial statements. Further, audit committees and external auditors must be diligent in fulfilling their responsibility to ensure that investors receive accurate, transparent, and timely information that supports investment decisions. Issuers must also consider how economic uncertainty impacts application of MD&A and other disclosure requirements. As referenced on slide number 33, there are a number of areas that may be impacted by the current economic environment. Issuers should ensure compliance with these existing regulatory reporting requirements where applicable when preparing continuous disclosure filings. I would like to emphasize that although this presentation discusses topics that are likely to affect many issuers, it does not provide an exhaustive list of all requirements. Each reporting issuer should consider the reporting and disclosure issues specifically to its circumstances in the current economic environment. Issuers are encouraged to refer to CSA Staff Notice 51362, Staff Review of COVID-19 Disclosure and Guidance for Disclosure Improvements, which highlights existing requirements that may be relevant to issuers in fulfilling their disclosure obligations under security legislation during times of economic uncertainty. This staff notice is referred to COVID-19. However, it also provides relevant and applicable guidance for the current economic environment. In our next few slides, we will go into further detail on a few areas that may be impacted. As referenced on slide number 35, we remind you that items 1.6 and 1.7 of Form 51102F1 require a discussion of an issuer's liquidity and capital resource. Staff expects that the discussion will address in sufficient detail how your company will respond to the current economic environment to satisfy both your short-term and long-term liquidity demands and capital expenditure commitment, whether it is through operation, taking out additional debt facility, deferring planned projects and capital expenditure, or reducing discretionary operation expenditures such as employee wages and bonus. In addition, items 1.6 and 1.7 of Form 51102F1 require issuer discuss any defaults on arrears or significant risks thereof on the issuer's ability to fulfill payments towards its contractual debt obligation and its ability to satisfy its financial and non-financial covenants associated with its current credit facility and debt obligations. We would also like to remind issuers that this discussion should also touch on how the issuer intends to address potential defaults or arrears, as well as the implication of any cross defaults in the current economic environment. So here is an example of deficient or boilerplate disclosure related to liquidity and capital resource. I will just pause a moment here to allow participants to read it through. The example here merely repeats information that can be found in the financial statements. It lacks a discussion of what this balance means in relation to the liquidity and capital resource of the company. Here, the company has a working capital deficiency of 200,000, but does not explain how it plans to address this deficiency. Further, given challenging market conditions, the company has not provided enough information to assess the likelihood of alternate source of financing. I will just pause a moment here to allow participants to read through the improved disclosure on slide number 37. So the disclosure here provides a more thorough discussion of the issuer's current financial position, along with a discussion of the issuer's plan to fund ongoing operation during times of economic uncertainty. In addition to the discussion of issuer's liquidity and capital resource, we also expect that reporting issuer will consider the entity-specific risk factors that apply to your business as a result of the current economic environment in accordance with item 5.2 of Form 51102F2. I would like to emphasize that There is no one-size-fits-all model for issuers to follow when discussing those risk factors associated with the current economic environment in their annual information form and MD&A filings. The resulting business impact, effects on financial performance, and specific risk factor resulting from such current economic environment will differ by industry, geography, and even reporting issuer. Therefore, staff expects that reporting issuer will avoid boilerplate language in their risk factor disclosure. Furthermore, we also wanted to highlight some areas that may be subject to significant judgment and estimation uncertainty, especially during the economic uncertainty that issuers should consider when preparing their financial information disclosure. Assessing going concern, including projections of cash flows, measuring impairment, including developing probability weight cash flow projections for measuring the recoverable amount of non-financial assets, or estimating expected credit loss for accounts payable. Developing significant inputs into fair value calculation, particularly for those inputs that are not observable. Determines the extent of government assistance eligibility, including nature and amount. Determine the extent to which deferred tax assets are recoverable. Estimating variable consideration, including refunds, returns, and rebates as part of the revenue recognition process. And of course, this list is not exhaustive and other areas may certainly exist. And lastly, we remind issuers that entity-specific disclosure about new or updated significant judgment as estimates must be included in an issuer's interim financial statements as well. Now I will pass to Jonathan, who will take us through non-GAAP and other financial measure disclosure.
Okay, thank you, Yolanda. So today I'll be covering National Instrument 52-112, which will include a summary of the new non-GAAP and other financial measures rule, including its application, scope, and definitions, and I'll also be providing a snapshot of the related disclosure requirements. So I'd like to start by pointing out just briefly the difference between a GAAP and a non-GAAP measure. So generally speaking, a GAAP measure is one that's recognized, measured, presented, and disclosed in accordance with generally accepted accounting principles, otherwise known as GAAP, such as IFRS. Measures found directly on the face of the primary financial statements, which includes the balance sheet, income statement, statement of cash flows, and changes of equity, are GAAP measures, whereas non-GAAP financial measures can be found only outside the financial statements, including outside of the financial statement notes, and that could be in instances such as measures disclosed in the MD&A. While we will look at the specific definition of a non-GAAP measure in a few slides, non-GAAP measures are generally adjusted in some way to add to or subtract from a GAAP measure. As a non-GAAP measure depicts a different picture of performance, position, or cash flow than a GAAP measure does, staff's concern is that absent appropriate disclosure, these non-GAAP measures may be misleading. Okay, so National Instrument 52-112 sets out the disclosure requirements relating to non-GAAP and other financial measures to help improve the quality of information provided to investors for various financial measures that commonly lack a standard meaning. We'll walk through the instrument in three parts. So first talking about its application, who the instrument applies to. Next, talking about the definitions of the different types of financial measures in the instrument, and then what the instrument applies to. And then lastly, talking about the disclosure requirements themselves. So when the instrument applies, what disclosures are required. The companion policy that accompanies the rule was developed to complement the instrument, and it includes guidance, interpretations, examples, illustrations, and a flowchart, which was included in response to stakeholder feedback that we received. We've heard that this flowchart in the companion policy has been useful to preparers in determining if a particular measure they've disclosed is a specified financial measure that is subject to the instrument. So as outlined in sections 2 and 4 of the instrument, the non-GAAP rule applies to reporting issuers broadly, except for investment funds, SEC foreign issuers, and designated foreign issuers. And what I want to emphasize about that is that Canadian domiciled SEC issuers that do not meet the definition of an SEC foreign issuer in 71-102, so those Canadian domiciled SEC issuers do need to apply this rule and are not part of the scope exemption that I mentioned. For non-reporting issuers, this instrument applies to documents subject to National Instrument 41-101, such as a long-form prospectus, but it could include other documents such as an information circular. Documents filed in connection with the distribution made in reliance on the offering memorandum exemption under National Instrument 45-106 are also in scope. Documents submitted to a recognized exchange in connection with a qualifying transaction, a reverse takeover, a change of business, a listing application, a significant acquisition, or other similar transaction is also captured. In the middle column on this slide, we've listed the most common documents that the instrument will apply to. Examples include the MD&A, news releases, earnings releases, and social media or website postings. However, in section 4 of the instrument, there are certain application exemptions indicating where the instrument does not apply to certain disclosures or documents. Examples of some of these application exemptions are included in the third column of this slide, such as certain specific technical disclosures for mining and oil and gas issuers, third-party reports like analyst reports, valuation reports, fairness opinions are also exempt, as are transcripts of an oral statement, pro forma financials that are required to be filed under securities legislation, a material document or contract filed under Section 12 of 51-102, disclosures required under law or by a self-regulatory organization are exempt, covenants and written contracts are exempt, and lastly, certain disclosures made by registered firms are also exempt from National Instrument 52-112. So if you're an issuer to which the instrument applies and where one of the application exemptions that I mentioned does not apply, then the next question to consider is whether you're disclosing a specified financial measure, where a specified financial measure refers to 6 different categories of financial measures that are each within the scope of 52-112, and of which a historical non-GAAP financial measure is only one. So each of the definitions for the various types of financial measures that are captured by this rule are summarized on this slide. Let's start talking about non-GAAP financial measures. So a non-GAAP financial measure depicts the historical or expected future financial performance, position, or cash flow of an entity. Items such as share price, market capitalization, or credit rating do not depict historical or future financial performance, position, or cash flow. And as such, they would not meet the paragraph A definition, and they would not be non-GAAP measures. For paragraph B, the composition excludes an amount that is included in or includes an amount that is excluded from the composition of the most directly comparable financial measure. So that's saying to be a non-GAAP measure, you need to be adding or subtracting things amongst different financial statement lines. And lastly, for paragraph C and D, it's not a measure that's disclosed in the financial statements, and it's not a ratio, fraction, percentage, or similar representation. For non-GAAP ratios, the second row on the slide, as per the title of the measure, it's not a ratio. It is a ratio, sorry. But the key aspect here is that it is a ratio or percentage that has a non-GAAP financial measure as one or more of its components used in its calculation. Also, to meet the non-GAAP ratio definition, the measure can't be disclosed in the financial statements. For the remaining types of measures on this slide, I'll just highlight certain key aspects of each of their definitions. For total of segment measures, it's a subtotal of 2 or more reportable segments, typically within the financial statement segment note. The disclosure requirements for this measure ensure that if a total of segment measure is disclosed outside of the financial statements, then context is provided for that disclosure. For capital management measures, these are measures that are intended to enable an individual to evaluate an entity's objectives, policies, and processes for managing the entity's capital. And to meet the definition, they must be disclosed in the financial statement notes, typically the capital management note. Again, the related disclosure requirements ensure that context is provided when these measures are disclosed outside of the financial statements. And lastly, for supplementary financial measures, so this is a measure that is or is intended to be disclosed on a periodic basis to depict the historical or expected future financial performance, position, or cash flows of an entity, and which is not disclosed in the financial statements. It's not a non-GAAP measure and not a non-GAAP ratio. Those are the criteria in that definition. And as a result, it's relatively easier to be caught by the supplementary financial measure definition. But if you are caught, the main disclosure requirement is to simply explain the composition of the measure so that investors can understand what the measure is and how it's calculated. The flowchart that I mentioned earlier in companion policy for 52.112 is again a very useful tool for issuers attempting to determine what type of specified financial measure a particular financial measure may be, and therefore what the related disclosure requirements are. So each column on this slide depicts each of the different types of measures that we just discussed as being in scope of this rule. The slide also highlights the section of the instrument at the bottom where the disclosure requirements for each specified financial measure can be found. We've also provided an example for each specified financial measure for each column on this slide. For example, adjusted net income is an example provided for non-GAAP financial measures. We'll go through each of these examples in more detail over the next couple of slides. So let's take a closer look at each of these specified financial measures and examples. So on the left-hand side of this slide, I have an excerpt from an issuer's income statement. And as you can see, adjusted net income is not a measure included in the issuer's primary financial statements. And for the purposes of this presentation, it's also not a measure disclosed in the issuer's financial statement notes. But it is a measure disclosed outside of the issuer's financial statements, in this case in its MD&A. For this example, adjusted net income is a non-GAAP financial measure that is historical information because it depicts historical financial performance. Its composition excludes restructuring and acquisition costs, finance costs, and income tax recovery and expense from the nearest GAAP measure, which is net loss or net income, disclosed in the primary statements. Also, adjusted net income is not a measure disclosed in the financial statements, and it's not a ratio. So again, it does meet the non-GAAP financial measure definition, and it would be subject to the disclosure requirements outlined in Section 6 of the National Instrument. The next example is a variation on the last one, except that it is now a non-GAAP financial measure that is forward-looking instead of historical in nature. So in this case, the expected adjusted net income non-GAAP financial measure is presented in a financial outlook table in the MD&A for the issuer's upcoming fiscal year, it's next year. This would be subject to the disclosure requirements in Section 7 of the instrument for forward-looking non-GAAP measures. Okay, this slide has another variation on the first example, but in this case, we're showing adjusted net income as a per share amount, which then meets the definition of a non-GAAP ratio because the adjusted net income per share is a ratio with a numerator and a denominator. The ratio is calculated using a non-GAAP financial measure, adjusted net income as the numerator or one of its components, and it's not a ratio that's been disclosed in the issuer's financial statements. So as a result, this would be subject to the non-GAAP ratio disclosure requirements in Section 8 of the instrument. The next example is for total of segment measures. On the top left, we have an excerpt from the issuer's consolidated income statement. And as you can see, EBITDA is not a financial statement line item on the primary financial statements on the income statement here. On the bottom left, we have an excerpt from the segment notes in the issuer's financial statements, where EBITDA has been disclosed as a metric for the issuer's total reportable segments and for the individual segments individually. The total of segment EBITDA, as in consolidated issuer EBITDA, is also disclosed in the financial highlights table in the issuer's MD&A. And this disclosure in the MD&A represents a total of segment measures because it's a total or a subtotal of 2 or more reportable segments. It's not a component of a financial statement line item, and EBITDA is not disclosed in the issuer's primary financial statements, but it is disclosed in the notes to the financial statements. So this would be subject to the disclosure requirements in Section 9 of the instrument. For the next example, we have an excerpt from an issuer's capital management financial statement note. The net debt measure that is disclosed in the liquidity and capital resources section of this issuer's MD&A is a capital management measure because net debt is a measure that evaluates objectives, policies, and processes for managing capital of the issuer. Net debt is not a component of a financial statement line item in the primary financial statements. It has been disclosed in the financial statement notes of the issuer, but it is not a measure that's been disclosed in the primary financial statements of the issuer, also known as the face of the statements. So this would be subject to the disclosure requirements in Section 10 of the instrument. Okay, and this last example is for a supplementary financial measure. On the left, we have an excerpt of the consolidated income statement. In the MD&A, the measure, in this case, same-store sales, has been disclosed, where same-store sales is basically revenue from stores that have been open throughout the entire current and prior year. And we've determined here that same-store sales is a supplementary financial measure because it's disclosed quarterly to depict historical financial performance of the issuer. It's not disclosed in the financial statements. It's not a non-GAAP financial measure, for instance, because it does not include or exclude amounts from other line items on the primary financial statements. Sales used in the calculation of same-store sales has been calculated in accordance with the accounting policies used to prepare the revenue line item presented in the primary financial statements. If same-store sales was, for example, presented on a constant currency basis, then it would effectively be adding or subtracting amounts from the foreign exchange expense line item on the P&L together with amounts from the revenue line item, and that could make it a non-GAAP measure, but that's not happening in this example, since same-store sales in this example is merely a subset or a component of the GAAP revenue line item on the primary financial statements. And lastly, in this example, same-store sales is not a non-GAAP ratio, it's not a ratio, so it meets the supplementary financial measure definition for all these reasons. This would be subject then to the disclosure requirements outlined in Section 11 of the instrument. Okay, so moving beyond those examples, I also have a slide here on the ability to incorporate this instrument's disclosure requirements by reference. A common question that we hear is whether the disclosures required in this instrument need to be disclosed in each and every discrete document where the related financial measure is disclosed. And the answer is not necessarily, as there are certain circumstances where issuers can comply with certain disclosure requirements by incorporating that disclosure by reference, by pointing to another document where the required disclosures are provided. Section 5 of the National Instrument outlines what information can be incorporated by reference, what issuers have to do when incorporating information by reference, and it also explains certain restrictions when incorporating information by reference. For example, an issuer may not incorporate a quantitative reconciliation to the nearest GAAP measure if the document in which the measure is being disclosed is an earnings release. An earnings release must contain a quantitative reconciliation to the nearest GAAP measure, and its incorporation by reference is not permitted specifically in the case of an earnings release. On this slide, we've presented a snapshot of the disclosure requirements for each of the 6 different types of specified financial measures in scope of this rule. The footnotes related to this information are found in the next slide. There are a total of 10 disclosure attributes in the rows on this slide, and as you move to the right of the slide, there are less disclosures that are required for each of the specified financial measure categories. So for instance, when a total of segment measure is disclosed, fewer disclosure requirements applied than with only 4 out of 10 disclosure attributes being applicable as compared to a non-GAAP measure, which requires all 10. And moving further to the far right of the table, for supplementary financial measures, only the labeling and composition disclosure requirements apply. So that concludes the non-GAAP and other financial measure portion of the presentation. I'll pass it back to Darren to go through forward-looking information.
Thanks, Jonathan. So forward-looking information, or FLI, because it's a bit of a tongue twister, just includes any disclosure about possible events, conditions, or financial performance that's based on assumptions about future economic conditions and courses of action. And within this includes 2 subcategories dealing with financial information. So future-oriented financial information, or FOFI, and financial outlooks. While both FOFI and financial outlooks are measures of prospective financial performance, the difference between the two is the format in which the financial information is presented. Future-oriented financial information is presented in the format of a historical financial statement, whereas financial outlooks, on the other hand, are not, and often include examples such as projected EBITDA, expected revenue or profit, projected EPS, or forecasted R&D spending. We don't often see FOFI in continuous disclosure filings. We typically see those used in prospectuses or rights offerings. And while FOFI and financial outlooks are 2 subsets of FLI, FLI also includes non-financial measures, such as an estimate of future store openings, for example. The disclosure requirements related to forward-looking information are set out in the following sections, parts within National Instrument 51-102. So Part 4A sets out the broader disclosure requirements when using forward-looking information. Part 4B includes disclosures specific to FOFI and financial outlooks. And Part 5.8 sets out the disclosure requirements for previously disclosed financial-looking information. FLI is an area of particular interest to many investors, as it can provide valuable insight about an issuer's business and how it intends to achieve its corporate objectives. However, FLI is by definition likely to be less reliable than historical information because it's based on management's judgment and assumptions about the future. Because of this, it's important that FLI is clearly identified so that users understand the limitation of this information and don't treat it as historical information. Issuers should also provide clear and transparent disclosure that allows users to understand how the FLI is developed, understand the material risks, as well as how the information is updated. This slide highlights some of the key requirements to consider when disclosing FLI, which include only disclosing if you have a reasonable basis for the FLI, identifying material FLI as such, and cautioning users about material risk factors and that actual results may vary, stating material assumptions used, describing the policy for updating, and then when developing FLI, limit the period presented to the period with which the information used in determining the FLI can be reasonably estimated. So over the next 2 slides, we'll walk through an example. On this slide, we have an example of a deficient disclosure. Just to summarize this, we have an issuer in the earlier stages of operations that's very growth focused. They provide a table illustrating the total number of stores opened and the total sales recorded for the last 2 fiscal years. And then in addition to the historical information, they discuss future growth targets, which are to increase store count by 70 new stores for 2022, and then anticipate they'll reach 256 by the end of 23, 400 by the end of 24, and expected sales to grow up to 500 million. As you can see highlighted on this slide, there's a number of deficiencies in this disclosure. So first, the issuer has presented substantial growth in both the number of stores and total sales for the next 3 years, which does not appear to be supported by reasonable assumptions given their historical performance and considering it's only been operating for 2 years. The issuer also fails to disclose the assumptions used in developing the growth targets and or the related material risk factors that could cause actual results to differ materially from the FLI disclosed. And so building off that example, this slide presents improved disclosure. I won't read through it in detail, but you can see that the financial outlook has now been limited to a period of 1 fiscal year for which the information in the outlook can be reasonably estimated. Secondly, the assumptions supporting the outlook are clearly disclosed and appear to be reasonable given the issuer's limited operating history. And finally, you can see the issues also disclosed in the footnote via cross-reference to the relevant section in the MD&A, the material risk factors that could cause actual results to differ materially from the FLI previously disclosed. So given that the objective of FLI is to provide prospective information about future performance, issuers are also required to make and disclose updates so that investors can understand how an issuer is progressing towards achieving these objectives, as well as how actual results differ from what was previously disclosed. As mentioned earlier, Section 5.8 of 51-102 requires issuers to disclose in the MD&A or in a press release events and circumstances that are reasonably likely to cause actual results to differ materially from what was previously disclosed. Issuers must also provide a discussion of any material differences and updates to any relevant assumptions used or risks associated with previously disclosed FLI. And while there's flexibility in how the issuer discloses updates in its FLI, which allows for updated information to be included in a news release or prior to filing the MD&A. This approach would help to ensure that updates are communicated to investors on a timely basis. However, the MD&A must reproduce or refer to the information in the news release to satisfy the requirement in 51-102. Including the information only in a news release instead of the MD&A is not permitted. So in the interest of time, I'll let you read through these examples on your own, but this table highlights how the issuer from our early example might update previously disclosed forward-looking information, including progress on actual store openings, as well as updating previous assumptions that are no longer appropriate, which you can see in the last slide there. And so sometimes issuers may have disclosed forward-looking information which later becomes clear they're not going to achieve. In this case, an issuer may decide to withdraw the previously disclosed information. When withdrawing FLI, an issuer must disclose the events and circumstances that led to the decision to withdraw the information, including a discussion of any assumptions that are no longer valid. This slide highlights another example where you can see the second quarter of 2022, they became aware of a restriction on sales of a particular product, which ultimately resulted in the assumptions used in the revenue projections to be unreasonable. So you can see that they are withdrawing this previously disclosed revenue projections and provide an update with respect to other capital expenditures, which are also affected by the change in assumptions. And so with that, I'll pass it back to Alexandra to walk through problematic promotional activities.
Thanks, Darren. Over the next few slides, we'll discuss problematic promotional activities and also take a closer look at overly promotional disclosure and greenwashing. So in November 2018, staff published CSA Staff Notice 51356 to illustrate some of the problems we've observed in filings containing overly promotional language. The purpose of this notice is to illustrate examples of specific problems we've observed, to reinforce the CSA's commitment to ensuring promotional activity by or on behalf of issuers remains balanced and not misleading, and to outline staff's expectations and guidance for issuers when engaging in promotional activities. The expectations set out in the notice apply to disclosure and activities of all corporate issuers, including both venture and non-venture issuers. We've also set out some additional CSA and OSC staff guidance here that issuers and their advisors can refer to regarding disclosure standards, promotional activities, social media disclosure controls, best practices for disclosure in press releases. This next slide has some examples of promotional activities that may potentially be misleading, including disseminating presentations, marketing materials, social media posts, or other information that describes early stage business plans with unwarranted certainty or makes unsupported assertions about growth of markets or demand for a product. Compensating third parties who use social media and general investing blogs to promote issuers, but do not disclose their agency, compensation, or financial interest as related to an issuer. and announcing a change in business to reference emerging industries without providing any supporting business plans or risk disclosures. We encourage you to refer to CSA Staff Notice 51356 for additional examples of problematic promotional activities and the related guidance. Disclosure must be factual and balanced, giving equal prominence to favorable and unfavorable information, with unfavorable information being disclosed as promptly and completely as favorable information. Increasingly, we are observing reporting issuers that disseminate numerous news releases that include overly promotional or good news announcements, and do not balance this disclosure with unfavorable information that may also exist. We are concerned that this type of promotional disclosure may artificially increase an issuer's share price or trading volume, which undermines the integrity of capital markets and puts investors at risk of harm and making misinformed investment decisions. Issuers should not make overly promotional statements in their continuous disclosure about their business without providing sufficient support for those statements. For example, a statement that an issuer is the largest in its industry or market should be supported by objective data that provides the issuer with a reasonable basis on which to conclude that that statement is accurate. This is also true for assertions about growth of markets or demand for a product. As another example, disclosure of early stage business plans of a new business, objective, or strategy, or even material claims about an issuer's business and any corresponding opportunity should be substantiated or balanced with a discussion of the issuer's business plans, milestones and expected timing, capital requirements, and any associated risks. Staff expect issuers to comply with relevant securities law and to follow guidance about promotional disclosure and activities, including the general prohibition against false or misleading statements that are expected to have a significant effect on share price or volume. OSC staff recently provided some tips in the Corporate Finance Branch 2022 annual report related to disclosure best practices for press releases, which we've included in this slide for your reference. We did want to highlight one specific area that is very topical at the moment. The use of disclosures pertaining to ESG or sustainability factors has grown rapidly in recent years as companies look to be more transparent on how they manage ESG factors and related risks. The terms ESG and sustainability are used to refer to a wide variety of factors, including pollution and waste management, biodiversity, climate risks, carbon and other greenhouse gas emissions, energy efficiency, diversity and inclusion, human rights, Indigenous reconciliation, labor standards, corporate governance, shareholder engagement, bribery, and corruption. The scope of what is encompassed by these terms can make using the terms misleading if there is not more specific disclosure about the particular factors being considered and how they are being measured and evaluated by an issuer. We have concerns with issuers that appear to be making potentially misleading, unsubstantiated, or otherwise incomplete claims about business operations or the sustainability of a product or a service being offered, conveying a false impression commonly referred to as greenwashing. As described in CSA Staff Notice 51364, greenwashing may be present in both continuous disclosure documents as well as voluntary documents, such as sustainability or ESG reports and public surveys. When describing current and proposed ESG-related activities, issuers should avoid misleading promotional language. With increased access to data and information online, it is important to ensure that all public disclosures, whether voluntary, are both factual and balanced. In this example, the issuer made an unsubstantiated claim stating that it would be carbon neutral in the very near term. Unless this statement is supported by facts and specific corporate activities, it may be misleading and promotional to include in the issuer's disclosure. This type of statement will typically constitute FLI. As Darren discussed earlier, an issuer must have a reasonable basis for the FLI, identify the material risk factors that could cause actual results to differ materially, state the material facts or assumptions used to develop the FLI, and describe its policies for updating this information. The issuer also included potentially misleading and promotional language by describing itself as being a global leader, despite having generated only nominal revenue from its operating activities, and including statements about its partnerships without any accompanying disclosures to support the issuer's claims about a key partner being high quality or its aggressive emissions reduction targets. In this example, the issuer should have ensured that any potentially promotional statement related to ESG and sustainability factors was supported by objective data that provided a reasonable basis for the issuer to conclude that its statements were accurate. Lastly, we wanted to highlight potential regulatory responses to problematic promotional activities. And these are cited in CSA Staff Notice 51356, including requiring an issuer to issue a clarifying news release, or in some instances, to refile continuous disclosure documents entirely. This concludes our session for today, and I'll turn it back to Maria for a few concluding statements.
Thanks. I'd just like to take a minute to thank Jonathan, Darren, Yolanda, and Alexandra for sharing their knowledge and expertise with us today. Before we proceed to the Q&A portion, I'd like to draw your attention to the appendix in the handouts in the slide deck, which contains contact information for today's presenters. Just note that while staff are happy to answer questions, this does not replace the advice of independent third-party advisors.